The last time this indicator lit up like this, silver tripled in 18 months. Before the 2008 crash, it fired. Before silver's historic spike to $50 in 2011, it fired. Before the 2020 moonshot that caught Wall Street completely off guard, it fired. And right now, in April 2026, it just fired again. I'm not here to hype you. I'm not selling coins. I'm not running a newsletter. What I am doing is showing you exactly what this indicator is, what the data says, and what historically happens next, so you can make a decision before the crowd even knows what's happening. Stay with me for the next 9 minutes, because if you've ever thought about owning silver, or you already do, this is the most important video you'll watch this year. And I say that not to grab your attention. I say that because the data, the history, and the macro environment are all pointing in the same direction at the same time. That is rare. And when it happens, the people who are paying attention are the ones who win. So let's get into it. What is this indicator, and why does it matter so much? It's called the gold to silver ratio. And most people either don't know what it is, or they wildly misunderstand it. The ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, that number sits above 88. Let that sink in for a second. It takes 88 ounces of silver to buy just 1 ounce of gold. Now you might be thinking, okay, so what? What does that number actually mean in the real world? Here's what it means. Historically, and I mean going back over 100 years, whenever this ratio climbs above 80, silver doesn't just recover, it explodes. Because what the ratio is really telling you is that silver is historically cheap relative to gold, and the market eventually always corrects that imbalance. Not sometimes, not usually, every single time. The historical average of this ratio over the past century sits somewhere between 50 and 60. Right now, we are at 88. That is not a small deviation. That is a massive, screaming, flashing signal that silver is deeply undervalued relative to where it has historically traded against gold. And when mean reversion kicks in, and it always does, the move in silver can be breathtaking. Let me walk you through the history so you can see this with your own eyes. In 2003, the ratio hit 80. Over the next 8 years, silver went from under $5 an ounce to nearly $50. That is a 900% move. People who understood the ratio and positioned early retired on that trade. In 2008, during the height of the financial crisis, the ratio spiked above 80 again as panic selling crushed silver along with everything else. But within 2 years, silver had more than quadrupled off those lows. The fear created the opportunity. The ratio told you exactly when to act. In March 2020, the ratio hit an all-time record, above 120, when COVID panic sent investors fleeing from everything and running to cash. Silver got absolutely decimated. But within just 5 months, silver had nearly tripled. It was one of the fastest, most violent precious metals recoveries in modern history. The people who bought when the ratio was screaming, "Silver is on sale," made fortunes. The people who waited until silver was on the news bought near the top. Every single time, 2003, 2008, 2020, this ratio has screamed, "Silver is dirt cheap." Silver has answered, and today we are sitting at 88, deep in the danger zone for those on the wrong side, deep in the opportunity zone for those who understand what this number means. But here is what makes this particular moment genuinely different from those previous setups. It is not just one indicator firing, it is a full convergence of multiple powerful forces. And that kind of alignment only happens once or twice in a decade. Let me break each one down for you. The first force is central bank gold buying. Central banks around the world are buying gold at the fastest pace since the 1960s. Countries like China, India, Poland, and Turkey have been accumulating gold aggressively, not just as a reserve asset, but as a deliberate move away from dollar dependence. Now, here is why that matters for silver. When central banks stack gold aggressively, silver has historically followed with more volatility and more upside percentage-wise. Gold tends to lead. Silver tends to follow, harder and faster. So if central banks are signaling something with their gold buying, silver is where the leverage lives. The second force is industrial demand, and this one is genuinely unlike anything we have seen before in the history of this metal. Solar panels, electric vehicles, AI data centers, semiconductor manufacturing, medical devices. Every single one of these industries runs on silver. Not gold, not copper, silver. We are not just talking about a monetary metal sitting in a vault somewhere. Silver is now a mission-critical industrial commodity, and the supply cannot keep up with the demand curve we are heading into. Think about what is happening in solar alone. The world is building out solar energy at a scale that was unimaginable just 10 years ago. Each solar panel uses silver paste as a conductor. Millions of panels, hundreds of millions planned. The Silver Institute projects that solar alone could consume over 200 million ounces of silver annually within the next few years. That is roughly 20% of total global mine supply, consumed by a single industry. And that is before you even factor in EV batteries, 5G infrastructure, and the explosion of AI hardware that runs on silver-dependent chips. Meanwhile, silver mine supply has been essentially flat for years. You cannot just flip a switch and open new mines. It takes years of permitting, investment, and development. The supply side is structurally constrained at the exact same moment that demand is structurally accelerating. That is not a temporary imbalance. That is a long-term structural deficit. And markets price in structural deficits, eventually and violently. The third force is the macro environment. The US dollar is under serious structural pressure. The national debt has crossed levels that were previously unthinkable. De-dollarization is accelerating across the global south. Countries that once held dollars as their primary reserve are quietly diversifying into hard assets. Real interest rates, despite everything the Fed has done, remain historically distorted. And when you have that kind of monetary instability as the backdrop, hard assets like gold and silver have always been where capital runs for protection. When you stack central bank buying, record industrial demand, a supply deficit, dollar pressure, and a gold to silver ratio at 88, you are not looking at a speculative trade. You are looking at a generational macro setup, the kind that comes along maybe twice in a lifetime. Now, I want to talk directly to the skeptics watching this, and I respect the skeptics. You are probably thinking, okay, but people have been talking about silver's big moment for years, and it keeps disappointing. Where's this legendary silver explosion everyone keeps promising? That is a completely fair pushback, and here is my honest answer. Silver is not like a growth stock. It does not drift higher slowly and steadily. Silver has a very specific and very predictable personality. It consolidates for long periods, sometimes frustratingly long, and then it moves fast, hard, and violently to the upside. The 2020 move happened in 5 months. The 2010-2011 move happened in less than 8 months from the point of breakout. If you're not in position before the move begins, you miss the majority of the gains. Because by the time CNBC is running silver segments, and your neighbor is asking you how to buy coins, the easy money is already gone. The ratio is your early warning system. That is the entire point of watching it. It tells you when silver is historically mispriced. It tells you when the setup is building before the crowd arrives. Right now, at 88, it is telling you exactly that. So what do you actually do with this information? That depends entirely on your situation, your risk tolerance, and your time horizon. I am not a financial advisor. This is not financial advice. Do your own research and consult a professional. But here is how serious precious metals investors typically think about a setup like this. Physical silver is the foundation. Coins, bars, rounds, whatever form suits you. No counterparty risk, no paper promises, no broker between you and the metal, just the asset itself. If the ratio normalizes even partially back toward its historical average of 60, the math on physical silver from today's prices is compelling. Silver mining stocks are the next layer for investors with higher risk tolerance. Miners give you leverage to the spot price. When silver moves 30%, a quality, well-run miner can move 80 or even 100%. That leverage works in both directions, so it is absolutely not for everyone. But for investors who understand the risk profile, quality miners in this macro environment can generate extraordinary returns. Silver ETFs and streaming companies exist for those who want exposure without the logistics of physical storage. Not everyone's first choice given the paper nature of the instrument, but a legitimate option for certain portfolios. The point is, there are multiple ways to get positioned. The worst outcome is knowing what this ratio is signaling and choosing to do absolutely nothing with that information. Let me bring this home. The gold to silver ratio has been one of the most reliable macroeconomic signals in financial history, not because of magic, not because of some secret formula, but because it reflects deep fundamental truths about monetary cycles, industrial supply and demand, and human behavior. When silver gets this cheap relative to gold, capital flows back into it. That is not a theory. That is the documented, repeatable historical record across multiple decades and multiple economic cycles. Right now, the ratio is at 88. Industrial demand is at record levels and accelerating. Central banks are loading up on gold at generational pace. The dollar is structurally weakened. Mine supply cannot keep up with demand. And the mainstream financial media still isn't paying attention. I have shown you the indicator. I have shown you the history. I have shown you the three converging forces that make this setup unique. What you do next is completely your decision. But if this ratio drops back towards 60, which is where it has historically returned every single time, silver at today's prices would need to move dramatically to close that gap. You do the math. The indicator is fired. The only question is whether you are going to be the person who acted on the data or the person who watches the replay 6 months from now wishing they had. If this gave you value, share it with one person who needs to see it. Drop a comment below telling me where you think silver is headed from here. I read every single one. And if you are new here and you want this kind of deep analysis every week, subscribe and hit the bell so you never miss it. See you in the next one.